We will see how far it goes and what caused it. Today, I have the pleasure of having Crypto Wizard with us. He's, as you all know by now, he's been with us for a quite long time, periodically helping us understand what's going on in the market data. He's a senior Glassnode analyst. Hi Z, how are you?
Hello, Sina. How are you doing?
Very good. I'm excited to dive into the data to see what happened today. What was behind all this jump, and what happened in different markets, and how has the risk profile changed, and so on.
Yes, let's do it. I mean, again, above 100,000, a lot of excitement on crypto Twitter, and let's see what's data saying.
Perfect. So I'm going to begin by just a quick review of what happened. So just from January 13th, we had this big, actually right around 13th, we had this big correction from that, what seemed to be an attempt to take 100,000, right? So we had a jump above 95,000, but a massive drop all the way back to 90, and actually a little wick below it. So we almost dropped below 90,000, or perhaps for a few seconds we did. And then from there, it was all upside from 90,000 to back to 95, then another leg, and we just got a correction yesterday back to 97, and today was another massive jump all the way up to 105 and slightly above that. So 108 probably here is our all-time high. So we are kind of looking to take that out. We'll see what happens. Especially today's move seems to be extremely related to news. So I'm not super excited about news-related pumps, but you got to take what you have. This is amazing if it lasts. So let's see how that goes, and let's see if the data supports a sustainable rally. What do you think about the price action before I move on?
Yeah, it was pretty exciting because we were heading down and we tested 89. And I mean, many can confirm this assessment. The crypto Twitter was calling for doomsday again. They will, it was go down. Me, myself, I mean, I was not expecting the bounce back that is strong, but it looks like people are front running the Trump. I call it trumping to a new all-time high all the time because when market reacts to Trump's news. So I think, yeah, it's there are lots of news around the treasury. I mean, strategic treasury of Bitcoin. Government is going to start. I don't know what it is. Where is the source of this news? But looks like the crypto market is reacting strongly to that. I mean, speculation.
Exactly, like a lot of speculation about what's gonna come in the next on the first day. And so let's look at a couple of news items that were discussed. If I bring back my screen, yes. So a bunch of things happened right today. So, Bitcoin massively pumped. Here it's very important. Wyoming filed for a strategic Bitcoin reserve bill. So this is a bill for the state of Wyoming, right? It's just a state legislature. It's not a federal one. Another similar thing happened in Massachusetts. They also filed for a strategic Bitcoin reserve bill. Important point, these are just bills. Like somebody made a proposal. This is completely different than something that than an actual strategic Bitcoin reserve. From the proposal to actually getting the votes and getting it done, that's a huge gap, but it's a wonderful step. And then moving on, like adding some more light, Bitcoin Magazine reported that Wyoming Representative Jacob Wasserberger introduced legislation for a strategic Bitcoin reserve. Very interesting that several states are discussing this. Similarly, Massachusetts one was proposed by Senator Peter Durant. Again, these are state senators, not as influential as the Congress. The speculation around SBR is also hyping up. On Polymarket, above 65% chance that it's happening. That's what the market is predicting. What is the strategic Bitcoin reserve? No one knows. And there isn't much of a concrete document we could look at. We have the Cynthia Lummis's bill. She's working on it still, trying to negotiate in Congress to get it passed. But her version is mostly discussing keeping the reserves, keeping the Bitcoin that the government already has. And it's a little bit vague whether there would be actually new, what would be the source of funding for the new Bitcoin purchases. There are actually, before this call, Wizard and I were discussing, it might take multiple forms. They might decide printing dollars to buy Bitcoin. But to me, that sounds a little bit too aggressive for the government. Essentially, that if they do that, that means they have shorted their own money to buy another money. So they would be intentionally weakening the dollar, and this can cause a rapid repricing of everything. So I don't think they would want to go that aggressive. The government would not be, destroying its own money. Instead, it might take a more conservative form where, they might buy some coins, but through another source, maybe by converting some gold reserves, some other reserves that the United States might have, or maybe selling some other currency that they have in reserve and then buying Bitcoin. Most likely is, just committing, the biggest commitment being that the government just keeps the Bitcoin it has and doesn't sell any of it. That's still a meaningful, interesting step, but it's going to be a lot easier to pass. So I would still be looking for the details of this before, getting into any conclusion. Plus, there is a big distance from discussion to actually passing something in Congress. So this is very interesting. This is good. It's signaling a positive change, but the actual change has a wide range of possibilities, from a nothing burger to a significant buys from the United States. Yeah. What do you think, Z?
Yeah, I totally agree. Like it is very hard to, be biased towards positive now or negative, either side. It's so hard because there's no detail. I was looking at the source of, because there was another news, two news. One was there was a quote or proposal. I'm not sure what was the correct term, but they were saying Donald Trump is going to support all cryptocurrency strategic reserve that are made in US. That was the term they used. And then there was another speculation. Okay, they mean Ripple and Solana. I think all these, founders going to Trump and see him recently is spending a lot of money on the campaign. They are cashing out. That's what my Bitcoin Maximalist side is telling me. They are cashing out whatever they spent on the campaign. Now they're speculating about the treasury of Ripple or Solana. And even if that happens, like you said, there is no mechanism, defined here. Is it going to be bullish? We don't know. Like, where they're going to print money to buy Ripple or Solana or Bitcoin? It's all vague, and there's no clear mechanism there. So I'm really skeptical, to be honest. First of all, I'm not sure it's going to be a thing. Like Polymarket said, in first 100 days, they're going to have treasury. I'm skeptical. I think people will beat the price much, much higher than it's supposed to be. And even if we have that treasury, we don't know how they're going to buy Bitcoin and put in treasury. One bullish long-term outcome, which I'm actually waiting to see, is, let's say there is the US treasury for Bitcoin, and we cannot speculate, okay, is it going to actually increase demand in midterm or not? We don't know. But What if other governments wants to do the same thing? That would be okay. For me, it would be okay. That's a, wow moment. Say, price is going to go up in long term because other governments are trying to establish another treasury like the U.S. government. That then I would say, okay, that is a bullish thing for long term. Otherwise, I think it's just a news without any reason. And if you go source back, especially today, they talk about Coinbase endorse that treasury. Of course, Coinbase is going to endorse any kind of like treasury because it's gonna that means like more business for them. There was an article on Axion, I think. Brian was talking about okay, they have 5 or 6 suggestion about what is the next step to bring more freedom, economical freedom to the world. One of them was he said, okay, we should endorse Bitcoin and have a treasury. So that was like some sort of suggestion. It was not an official endorsement, and even if there was a Coinbase endorsing this, that wasn't a guarantee that we're going to
Who
have a
cares? Who cares about Coinbase endorsing, right? So,
yes. Of course Coinbase is gonna endorse any treasury of any shitcoin or Bitcoin. So that my point is I think people are overreacting no matter if that happens or not. So that's what scares me all the time. If everyone are overreacting to something positive or even sometimes negative, I think this is gonna be something that people are gonna pay the price if they really rely on this news and go all in an asset, not just Bitcoin, any other asset. If you rely on what you hear on social media and react to that by spending money or selling, either way, you're gonna. I'm pretty sure that you're gonna regret it in both ways.
yeah, and I'm looking at the introduction of Lomis's bill. Let me show that. You can track bills. Oh, you can track the progress of different bills here. This is congress.gov official website. This is S4912. S refers to Senate. So this is a bill introduced in the Senate, Bitcoin Act of 2024 by Cynthia Lummis. Only she's on this. Typically, more people are there. Not typically, but sometimes a bill that has much more support, multiple people join, maybe bipartisan, but this is primarily championed by Lummis. Read twice, referred to banking committee. This means nothing. This is just a basic procedural action. It's been referred to the Senate Banking Committee, but nothing else has happened. So after introduction, it hasn't moved much. Nothing concrete done on it, and it has 0 co-sponsors. Like bills that really go through the process and get negotiated over and win some supporters, they begin to amass more and more co-sponsors. So essentially the progress is 0 at this point. Maybe after Trump's inauguration, they will do the main negotiation in the Senate to add more co-sponsors. Again, my point here is the fact that there is a proposal doesn't necessarily mean real change happening. So we just have to wait and see what's going on. If the Congress has to approve this, it's going to take a long time. So unless the market moves because of the emotional or psychological value of this. Anyways, doesn't seem to be any concrete progress here. Maybe they'll pick it up this year. We'll see. So that's the strategic Bitcoin reserve. Like you said, there's a lot of in my opinion, nonsense about Ripple, XRP, and Solana being included. That would be crazy, stupid, and impractical. So these guys are just trying to, scam you one last time to pretend that they are relevant. They just go to Mar-a-Lago, take a picture with Trump, and then post that on social media that we are getting deals. Well, Trump's optimal solution right now is to meet with everyone. Why would you alienate anyone, right? Especially at his stage. So he would talk to everyone, but from talking to actually getting anything is a huge gap. So I'm really surprised that the market cared actually about a news news about XRP and Solana we don't even have a source, right? It's kind of like somebody heard something and suggested something else, and a bunch of social media accounts interpreted it as imminent pump for the two coins. Anyways, that's another side of this. But as Trump comes in and as he supports the whole crypto space, not just Bitcoin, that has been his tune, then we should see a lot of these little pumps in all the other lagging coins that have been performing really disastrously so far compared to Bitcoin. But they might get a revival. Other than that, I guess we can move on to the data, right? And
Sure.
So I'll quickly review some valuation models that people should be familiar with by now to just see where we are after this pump. Are we now getting into an overvalued position, or where are we essentially on the risk spectrum? So here is my VPLI index. It was low earlier today. I made a post on Twitter and I said we are pretty in the neutral zone. We have moved up quite a bit since morning. Now we are at the higher end of the neutral zone. So VPLI is at 59. This is a metric that goes from 0 to 100. 100 meaning the highest heat, most risk of reversal. In other words, possibly the top. And we are only at 59 out of 100. So we haven't even got into kind of a heated zone or overheated zone. That's pretty good. And where this model comes from, it has its base is a power curve that essentially models the fair price of Bitcoin, and that fair price line kind of is in the middle point between a bull market top and a bear market bottom. It's the average point essentially, and we are kind of right around there. We are not much above what this model would suggest as a fair value. We aren't below obviously, but we're kind of hanging around there. So in my book, we are just somewhere slightly above the fair value. Nothing really unexpected at this time. Again, here's just better detail. The fair value would be at 86. We are at 105. And if this year is a bull market, we will just continue going higher and higher. So the fair value doesn't mean we're going to be always stuck at that value. We will trade above it, but we will come back down to it and go below. Exactly what happened earlier. So when ETFs came up, we were below, and then we quickly went up, above the line, below the line, above the line, and so on. Here's another look at another way to value Bitcoin is through a channel that is created by the Bitcoin quantile model. Top of the channel is quantile 99. Bottom of the channel is first quantile of the data. Essentially, these lines are created in a way that they cover 99% and 1% of the data. So that gives us a bound of possible range of values. And you can see where we are. Let's see if, getting closer. 105 falls right on the boundary of the 66 quantile. And if you look at the historical values, that 66 quantile that I have typically kind of indicates a phase transition. The tops of the bull market happen after this. So we are kind of playing with the boundary here. Like we did a little bit in the previous cycle, spending our time before we actually do get a real pump. We are playing with that boundary, flirting with it until another leg begins. So with that, by the way, this 66% doesn't mean there's only 30% more of return left. It's actually because it's a log scale. If I convert it into a regular non-log price scale, you would see that quantile 66 actually doesn't capture most of the gains. If we do get to the top of the channel, this would be, I think by the end of the 2026, this would be at 280. So there is another 3x left, but on the downside, if this year decides to go against what we think, and it ends up being a bear market, this model would suggest a drop back to 70,000. But it doesn't necessarily tell us which year is going to be bull market or bear market. But we are, for now, we haven't even entered the hot zone in this model. So at least based on price history, the data doesn't suggest any overheating. Will give us some more detail from another perspective and from the on-chain data. Okay, so let me stop my screen and share yours. All right, so first off, maybe give us a game plan for what's coming, and then let's dive into the data.
Sure. I'm going to use the week on chain that we did earlier this week when market was going, almost testing the 90,000. It was, I think, 92, 91 when we were writing this report on Glassnode. So in this report, I'm going to use the same structure to have this episode today. Is I'm going to do two things. First of all, say and focus on what cohort of the investors are going to be the main focus of on-chain analysts, the one that are looking at the midterm market speculations, and that's the short-term hold or new investors. We're going to look at the cost basis and see, okay, what would be the midterm low band and high band in the market, in terms of, like, if we hit the high band, we should expect some correction, and if we hit the low band, we probably get some support, like what we did in 89. Then we're going to discuss based on a couple of models that we can use to speculate about the midterm market price action and the threshold between bull market and bear market, that kind of models. We look at them and say, explain why 89 and 90,000 was actually a price level that you would expect to bounce back. And if we didn't see that bounce back, breaking below that or stabilizing below that price range would have been the start of a midterm, at least a midterm bear market. Why 89, 88 was an important price level. We're going to explain that. And for the second half, I'm going to just say something that is a little bit more complicated for people that are looking at on-chain data, but I'll try to simplify it and explain why the 4-year cycle is broken. And if we want to wait and start to assess the risk in the market, we have to look at the recent data. Using the whole history of the metrics, especially on-chain data, is becoming irrelevant because, as you can see, the maturation is happening. The market is more correlated with the macro event, and you cannot expect the macro event to wait 4 years and just be bullish for 2 years and then 2 years bearish. It is totally becoming a function of what's happening outside of the Bitcoin network, Bitcoin market, and Bitcoin market is becoming actually a risk indicator in the sense of, like, just the market itself. I'm not saying Bitcoin is a risky asset. I'm just saying it looks like Bitcoin is reacting to the risk environment, and when the risk is on, you would see there's a rally. Instead of looking at the halving and every 4 year expecting market is going to go up after halving, that cycle is breaking. That's evidence. Evidently, we can prove that. That's why when you want to do a statistical analysis or visually compare the current state of the market based on the historical data, you have to give weight to the last year of data instead of looking at the full 10 years. I don't know, from Genesis block. Sometimes that's what they look at it. That's going to be the second half, but I try to simplify what's the message. Starting talking about the market.
But that's a great point. I mean, that's a great point you mentioned. Bitcoin increasingly acts as an early warning sign and a leading indicator for macroeconomics. So whenever there is fear, the first thing that would sell off would be the most liquid assets, right? So Bitcoin in that sense actually acts as early sign. There might be some strategies where more sophisticated investors could use the signal that's in Bitcoin to improve their trading in other assets. But what's relevant for us is what has caused the 4-year cycles to happen so far does not have to act the same way moving forward. We actually do see quite a bit of range compression from the top to bottom of the cycle. So the significant pumps and significant drops and crashes are getting weak. So that's proven. That's already shown that you can find that pattern over time, definitely. Now that there's no reason that process cannot continue, and we actually get a completely different set of cycles or macro driven or other fundamental driven ups and downs. I think what's keeping the cycles going for now is mostly psychological factors.
Yeah, it's a dominance of the investor who is still believe in 4-year cycle. That's what I would say. Even if we have another, 4-year cycle, it is a function of what is the dominant mentality among investors. But that's fading away. Look at the just show some evidence. Look at the MVRV, which look at the ratio between the price and the cost basis of the all investors, which is like some sort of bubble indicator, how high we are, how deviated we are positively with respect to the cost basis of the market. You could see since early cycle, we were like up to 8 times higher than the cost basis. Then in the second cycle with 6 times, 2018, 4.8. And as you can see, there's a decay in the peak of the cycle. And the reason I put this line here, I'm not that naive to predict the next stop. We might as well see a big catalyst in the market and go and break this line. But so far, if you look at the peak of the market, you could see the return is diminishing in a sense of like just looking at the price itself. And if you want to use the whole history, for example, if you want to use last 2 cycle and say, okay, we should reach to 3.9 or 4.8 and then call the cycle top, that would be a big mistake because we are expecting the market to get the same level of profitability. So the message is we have to solve this problem, which I'll try to address in the second half of this episode. But you're right, like there is a shift in the 4-year, and if you measure the time difference between the tops, like 2019 and 2020, it is becoming almost closer to 2-year. If you want to use that number, it is becoming shorter and shorter. The cycle between last top to the second top, and the other thing we have to change is the definition of cycle, because traditionally we would say whenever we break the last all-time high, that is a new cycle, end of the beginning of another cycle, for example. But we have to define the cycle differently, and we can talk about it in a future episode. For example, we can use this concept: whenever more than 90% of the investor are in profit, that is a new cycle started, the cycle of profitability, instead of looking at the price by itself. Because here at 2019, when the price was almost close to the last all-time high, the majority of the coins were again in profit because many people bought at top, sold in the bear market. And you could see in terms of profitability, we were at the same level, even though the price was not at the same level. So we have to redefine the cycle and use another concept to say, okay, the new cycle is started. And even if we use the price, that 4-year is changing. The biggest evidence was the recent market reaction to the halving. We had an all-time high before the halving. So this is breaking, and we can today suggest a solution, a simple solution. But before that, let's look at the market itself. What was going on when we were writing this report? When we were writing this report, market was getting closer and closer to 90,000. And what we did, first of all, we tried to show who is in charge, who could be the potential sell side. And when we look at the URPD, which is literally looking at the supply and try to put supply in different buckets, and those buckets are defined by the cost basis. For example, if we have here around 380,000 of coin, those 300,000 coin had a cost basis of around like 18,000 here. Or like 100,000, at 100,000 we had around 390,000 coin with a cost basis of around $95,000.
So this chart shows from all the people that hold Bitcoin. If you go back to see when they purchased, you can figure out what was their purchase price, right?
Exactly.
So there's a lot of short-term holders that bought at 98, 99. And then there is several waves of long-term holders that purchased in 60 and maybe 40 and below that.
Yes, these are clusters. But the main point is, and the gray one for, as you pointed out correctly, the red is short-term holder, the one that bought in last 6 months, and the blue is the long-term holder. If you look at the short-term holder, there was a big cluster above 85 all the way to $108,000. And I think we can look at it different. Look at this chart differently. The biggest cluster, the price level was around 98. You could see. So 98. This is another way to show that URPD. But the point I want about to make was when the price was around below 100, like it was 90 something, it was just going left and right. It was around 90. The majority of coins in loss, almost all of them was owned by the new buyers. So if the price was going up and there was an air pocket, or this is called air pocket, that means there is a price range that not many coin moved hand in that price range. So if price was keep going down and putting psychological pressure on these buyers, the short-term holder, there was a chance that bearishness pushed these people to start to spend. That's why breaking below an 89 and stepping to this air pocket would be dangerous, because it would incentivize or scare these people who are. There was a big chunk of supply actually. It was about to scare them, and historically it's proven that the short-term holder would react drastically when the price break below their cost basis for a long time. That's why 89 was very important. And matter of fact, if you look at the cost basis of these investors, the short-term holder, let me open this. This is a beautiful chart. That's the chart that, to be honest, I open like probably 2 or 3 times per day. I would just look at it because there is a lot of insight in this one. So this blue line that you see here is the cost basis of this short-term holder. So look at all this supply you see here. Imagine we are measuring the cost basis of all these short-term holders. When you look at their cost basis, is around, earlier this week was around $88,000 and 100, but right now is 88.5. So this cost basis, if you go back all the way to 2022, the cost basis of short-term holder is actually a great price model that can be used to say what phase, to define the current phase of the market. When the price is below the cost basis of recent buyers or recent investors, that means the price and market in general is disappointing these buyers. They start to buy Bitcoin, but price is going down and down, and majority of the time, most of these new buyers are in loss. So they get capitulated. And in bull market, actually, the price gets stabilized above their cost basis. That means a majority of the times they are in profit. That's why they get incentivized to buy and more, and new buyers join the game. So using this metric, we can actually start to speculate about markets current state. And when we were getting close to 88, 89, you could see there was a high risk of these investors. If the price was stabilizing below 88, that would have scared a lot of them, because the majority of them would be in loss. And the other side of this coin is when the price get close to their cost basis, the ones that are still in profit, they might stop spending because they are close to the break-even point and there is no incentive to sell. So that is an equilibrium point. That's a decision point when the price get close to the cost basis. And when it was around 80, 89, you could see the second scenario actually played out. The sell pressure by these investors, the ones that were still in profit, I'm talking about these ones, that they had the cost basis of 60, 80 something, they stopped and the sell pressure actually decreased. And if you go back and look at the sellers' cost basis, you could see the majority of sellers were actually the ones that were in profit. The ones that were in loss, they didn't realize much loss when the price was below their cost basis. It was really astonishing. You could see 80%, 70%, or 50%. I have to look at the exact date that we are talking about, but between 50 to 70% of sell pressure between the market top, which was 108,000, when the market was here, all the way to 89. When you look at the sell pressure, it was mostly the people who bought in this chop solidation phase, as a checkmate put it. They were actually selling in profit after market was at 108. So they were realizing profit. But the ones that were in loss, the one that bought at 108, 105, above the market price, I mean, during the market top formation, they were really resilient. So that confirms another hypothesis that we had last week. There is a new player that is patient and buys at a certain price. It looks like I don't want to speculate these are ETFs or they're smart money, but they're patient and they do not react emotionally to market correction. That is the story so far. Even when you look at back in March all the way to October, you could see some like price, I mean, breaking down to the like a low band, which I explained what is low band is, but we didn't see something like COVID, even though the sell-off was pretty, I mean, huge at March market top, but still market was as soon as price get close to a specific price range, you could see there was a buyer stepping in and buying, but that buyer was not aggressively pushing the price all the way to 100,000. So I think that's going to be this. The
But I noticed an interesting pattern. Like
yeah,
if you look at early 2024, we were
hmm
above the cost basis.
yeah,
2024, January 24, for example, we were
January
above the cost
25.
basis, the blue line, and
Yeah,
then every time we came back, we did have a bounce back up. So as you said, when the price gets back to the cost basis of short-term holders, they make a decision. And in this case, they've been the decision was they buy more, and the price bounces back up. So that happened all the way through May, and exactly where you are. But after that
June.
point, I remember that the sentiment was bearish and depressing. So actually, from that point on, from June 21, that you're exactly at, kind of looks like the psychology changes. And now every time we go back up to the cost basis of short-term holders, they sell. So essentially, they say, okay, just give me my money back.
Yeah,
So it's like these short-term holders might, they react to the sentiment. When the market is kind of going down, it acts as a resistant, and people just try to sell when we're at that level. But when there is excitement in the market, like where we are right now, the cost basis of short-term holders does act as support. So that's very
yeah,
interesting.
yeah. And I think many might ask, okay, what is the yellow and red color? We just use the statistical band, I mean the standard deviation, and like looked at the historical data and said, okay, statistically, when price got close to one standard deviation above the mean value, that was like local or probably cycle top. And when we had the price go down one standard deviation below the cost basis, that was actually a good support level in strong bearish moments. Like look at even in bear market, we barely broke below this line. But these are dynamic concepts. You have to check these values every day, or this one is hourly chart actually. You can look at it every hour and use this as a risk indicator. But the bottom line is 89 was the cost basis of this cohort of investors. Looks like they stopped selling. I mean, even the one that were realizing profit, they stopped selling, and this time it acted as a resistance. But by the time we break below and stabilize, that is a strong indication of bear market. Even if we take the recent short bear market, when in June we broke below the cost basis and stabilized. By stabilized, I mean stay below it for a week, not that just 1 hour, 2 hour break below that. But we look at it this since June all the way to September, we had a bear market. So by midterm, I'm talking about more than 1 month bear market. That's historically been seen in the market when below. In the case of 2021, price breaking below the cost basis is actually took more than 1 year to break it back above it. So it's an agnostic in a sense, agnostic indicator in a sense, and you have to use it smartly. We are not saying, okay, we're gonna definitely break below when we touch it. No, you could see after 2 months we broke back. But when we break below, you could expect a midterm bear market. And right now, if you're interested to know what is the higher band, it's around 125. That means if we get close to 125, we could expect market getting some sort of like a strong sells pressure by these investors, and probably market get corrected. But that doesn't guarantee we're going to get to 125, right? Like here, when we were here, the top was around 77, but market didn't reach that 77 and start to correct itself and enter the bear market. The bottom line is
Yeah,
89.
but the trick is
Yeah.
these short-term holders, they just they can't handle too much profit, they can't handle too much loss, right? So when
Yeah.
when the price is much beyond their cost basis, which is the red band, red line, the risk goes higher. So we don't have to reach the line, but it just gets more and more risky because they are more and more incentivized to sell. Sorry for
Correct.
interrupting. Go ahead.
No. That's I really like it when you do the conclusion part. So if I want to show that what we just explained in a better way, this is another beautiful chart, which is a replica of this URPD, but they showed it on the y-axis. You could see these lines by the price. The cost bases have been marked by the price itself. You could see between 87 all the way to 70, yeah, 70,000. So 70 to 88. This gap is between the there is no big chunk of supply moving hand here. So that's what I personally was expecting price enter and do the bottom formation in this air pocket. But it looks like no, probably the Trump inauguration actually acted as a catalyst, and people are beating before the I think this is Monday. I think this the first day of the government is Monday. So they're trying to bid and say, okay, we're gonna have a strategy treasury. It looks like that's the way they're acting, is they're buying Bitcoin for future values. That's what I see in the market. But if we were going below 88, I was expecting the price get consolidated between these two price levels, because the buyers that bought at 77, look, they were hodling all the way to January when the price went 108 or 105, and still they are a hodler. So their incentive have been tested. It looks like they are buying for long term. The short term holder we wanted to spend, they spend from 108 all the way to 89. So let's see what happens. There are a couple of other metrics that I want to show, and I'm not using these models to speculate about what's going to be the bottom. It's just interesting. The most interesting thing that I found in price model after the short-term holder cost basis is the cost basis of the ETFs, and this is the depositing investor. That's telling us, let's take the inflow to the ETFs and look at what price, how much Bitcoin they bought, and find the cost basis of the buyers in the ETFs. I mean, I know it's a little bit complicated, but I'm talking about the price that the buyers at ETFs did and day one. Like, this is the cost basis of the depositor or buyers. Interestingly, all the way from June, where we broke below the cost basis of short-term holders and we had some correction, you could see price, as soon as price get close to the cost basis of Fidelity and BlackRock, price was bouncing back. It looks like that patient buyers that I was talking about, that's another confirmation. You could see there's a patient buyer, and most likely ETF played a big role during the market corrections in between June and September. And as you can see, their cost basis at the moment is around 68, especially BlackRock. I think it's the biggest ETFs now in terms of the IUM, is around 68. What I'm trying to speculate here is, if we had a bear market, let's say market was going down, personally, that 68 was another confirmation of that air pocket that I was talking about. I said between 70 and 88. That was the range I was expecting the market to consolidate. This 68 is confirming the lower band of that range again. So that was actually, I was about to use this as a, extra tool if we were breaking. But right now we're not breaking. Apparently, we're not breaking below 88, so we can use it in future. It is a model that I would look at it in a bear market and see if the price get close to the cost basis of these ETFs. What's going to happen? Are they going to start to buy when the price is close to their break-even point? So it's possible.
You may also be able to discover some variation in ETFs, because the person who buys ARK should have a different profile than a person who buys BlackRock or Fidelity. So you might see some interesting things there as well.
Definitely. Even now, okay, I mean, we're not even we're close to 1 year, and you could see there's a deviation between the behavior of Fidelity and IBIT. That is interesting. Like you said, the character of buyers in different ETFs could be totally different, and it's really interesting to see what happens in future. So far, all the way to September, it was pretty the same. But after September, you could see, wow, like IBIT, because they bought a lot in this rally, you could see the cost basis. But Fidelity didn't buy too much I mean, during this rally from 70 something to 108,000. So it's interesting. They're going to be in the deviation, and I mean, watching it is very, very interesting.
I can also tell you from a whole year of looking at ETF data, IBIT is the last one to sell. Like whenever price is correcting, you would see most other ETFs show outflows, but IBIT very rarely. So it really does look like these are long-term investors. Perhaps a lot of them are passive investors, but the profile is completely different. So maybe their cost basis has a different meaning than, say, Fidelity and other ones. Very interesting.
Yeah. Now I want to focus on Fidelity and BlackRock here, what they did during this rally. For example, BlackRock, look, we had a little bit outflow, or I mean weakness in the buy side after we break below 97. I mean in December, late December, you could see actually we saw an outflow from BlackRock, which doesn't happen much. You could see it's not very frequent. They had zero flow, but negative is very rare. But late December, we had actually a outflow, early January, and then that's a 14-day moving average. Let's make it weekly, and actually starting when we broke above, I mean 94 and all the way to, I think it's Wednesday and today, January Thursday. I don't think that today's data is out yet, but this week we had a outflow. I mean, and this is dollar value. It's not Bitcoin value. So they had like some sort of sell-off in this rally. But when we turn on all the, let's see, BlackRock. I mean, last 1 month, 6 months. When we turn on the Fidelity, you could see the Fidelity was buying. So we should look at the net value. When you look at net value, because BlackRock is the biggest, we had some sort of sell-off during this rally. That is a negative sign that what I saw. I mean, during this rally back to 105 today, I think it was the highest. I didn't follow the hourly price data, but it looks like they had a little bit sell-off at the end of the week. So let's see what happens. Does it affect the next week's market price action? I'm not sure, but maybe it become positive. But you could see the weakness compared to the rally.
What is the last day?
The last day we had January 16th.
Okay.
So we do not have today's data because they do it at the. I think they do it in 2 hours. Because
yeah. Oh well, some of them are reporting. Bitwise has reported 200 million inflow, which is wow for them.
Wow.
But let's see, BlackRock always reports the latest. I used
200 today. That is a huge number.
That's what I'm seeing in the feed, but
wow.
I can check and be sure. But that's massive number. If that's the case, BlackRock will probably report yes, over 200 million into the Bitwise Bitcoin ETF today.
Wow.
Posted by the ETF, the Bitwise, Hunter Horsley. So let's see. BlackRock should probably be doing like 400, 500 million now.
Yeah, because Friday, I think the majority of the recent rally to 105 happened today. I expect, and probably all of them are reacting to the Monday's inauguration. Probably, the strong buy. But you could say another reason when we were
one other thing I'll tell you is, just to wrap this up, wrap this piece up. The other thing is today was the expiry of a lot of options and many bets. Many people decide to sell in this last week because once Trump comes in, no one knows what's going to happen. So a lot of people try to close the bets. So the trading volume is the highest. Go ahead.
So if Monday, if we Monday we look back and see Friday we had a strong buy, I mean that's another positive sign. And all in all, what I was about to say in this session was we had a bounce back from a very significant price level, which was around 88, 89, or 90. That was the cost basis of short holder, and the other significance of this price was the moving average, the 1-year moving average. And I'm gonna just explain why 1-year moving average is important. It was around 91,000, 90,500. We had a bounce back from that region. That means like the cost basis, 1-year moving average is not necessarily the cost basis of the people who bought last year. So this moving average is really significant, which I'm going to explain why. We had a bounce back from the confluence of all these models. So it was really significant. And right now people can ask, okay, what is next if we keep saying and keep going up? One, we could use that one standard deviation that I talked about, which was around 126. The other one that I want to get into is gonna be, actually we have to explain where was the, okay, this one. The reason we're going to use 1-year moving average is to explain the reason. I have to get back to what I was about to explain as the second half of this session. And it goes back to the fact that the 4-year cycle is breaking. At least this cycle, we're seeing we had an all-time high before the halving, and like I discussed, there is a high chance that the 4-year cyclical behavior start to actually fade away, and we have like a different and unpredictable cycle in the market. And taking the MVRV, you could see the 4-year. If you take the 4-year cycle and use a normalization over every 4-year, and or use the whole historical value, you could see the Z-score, which is a normalization method for the MVRV. Even the normalization method is showing some decay. That means using the whole data, giving equal weight to every single available data is not going to work. Over time, you could see even the Z-score, the decay is happening. Because in the raw metric, the decay was happening. So the one way to fix this problem is we do normalization. And if we want to do normalization, we can normalization over the whole historical data or use a chunk of it. They call it rolling window. Or in a simpler term, we can use the recent data and look at how high the current state or how risky the current state is compared to last X number of data. And instead of looking at the current state of the market compared to the full history, because full history is irrelevant. We can give more weight to the recent data. So here we tested to different rolling window or different length of historical value that we can use and normalize the MVRV. Here we compare the 4-year instead of the full historical value. You could see there is no big difference between the green is 4-year and the orange is full historical value to do the normalization. You could see there is no difference, much difference, a little bit difference in bear market. Then we use 2 years rolling window, which is the last 2-year data to normalize the MVRV. You could see it's getting better. I mean, you could see during the top in 2021 and top 2018 and 2016, the tops that we had, and the top in 2024, you could see it is pretty in the same range. But at the same time, in 2019, when market got close to previous all-time high, or earliest stage of the 2024, when market had a big rally, it was not showing a lot of signal. I mean, a significant signal, even though we had almost 2x rally from the bear market bottom. So these are not being picked up because that 2 years is not short enough. Then we move to 1-year moving average, meaning we use only the last 365 days of data to judge today's data. Compared to last 365 days, are we in a high risk, or are we at the higher band of that metric, or no, we are at the lower band? Using this 1-year moving average or 1-year historical data, you could see we could almost pick every single major top in the market. That is why the 1-year is my new interest, the rolling window that I'm going to use to normalize different on-chain data. And looking at the 1-year Z-score or 1-year normalized data, the top at 108, the top at March, the top that we had in early January 2024, all of them was based on last year of data to that point was statistically significant, and market started to correct. And the level that is pretty consistently marking the high risk zone in the market is 2 standard deviation, meaning when we have a rally to 2 standard deviation or more above the moving average of last 1 year of price data, I mean MVRV, or this in this case is MVRV. When MVRV is 2 standard deviation or more above the moving average, last 1 year moving average, the market has a very high risk. And the conversely, when we had 1.5 standard deviation below the cost basis, market usually form this bottom and market start to bounce back at least for midterm. So using this 2 standard deviation and 1.5 standard deviation range, we can develop this model. Let me open it. So this model is literally looking at the price and using MVRV, 1 standard deviation, 1.5, 2 above, and 1.5 below. Let me turn off all of them. I just use the red line is the 2 standard deviation. When MVRV is 2 standard deviation above, it's 1 year moving average, and the blue is 1.5 standard deviation below the 1 year moving average MVRV. As you can see, it is a little bit skewed to the positive side. That's the nature of Bitcoin. Using this model, the top at the moment, the top model, the top is around 113, and the low model is around 75. I really like this actually compared to the other models because it is using last 1 year data and is really reactive to the mean value. And I would use this one in addition to the short-term holders cost basis. And I think from this episode and go on, I mean, starting from this episode and for the future episode, we probably keep updating the, viewers by these 2 models. First, the 1 year standard deviation model on MVRV, which is basically look at the profitability in the market using the recent data. If it's too profitable, that is high risk. If it is too, the profitability is diminished, to the lower level, that is very low risk, and also the cost basis of short-term holder. I think the confluence of these 2 models would be the strong market compass, and we can use it from now on in a future episode. What do you think, Sina?
Yeah, this sounds very interesting. I have done my previous studies on the decay that happens in Bitcoin. Obviously, as you correctly mentioned, we do have those decays over time, and it's not linear. It's not easy to normalize them. So figuring out a way to normalize and figure out like the old metric, a metric that in the past would have gone to some number, does it still go to up to the same level or not? That's very important. Otherwise, the metric has little value because you never know if it's too high or too low, right? So, but what you're doing seems to be doing a great job in providing a evaluation or sort of a risk metric. So the bands you were showing basically give us sort of like, the position of Bitcoin price in that range gives us a, risk metric, right? So if it touches the low level, you have the best buying opportunity based on this model. If it touches the top level, you have the highest risk of reversal. So, and you could even quantify the position within that channel, right?
Yep,
so to get a percentage based in terms of the heat overheated percentage.
Yeah, correct. And I really like the idea because it is very dynamic, and it is in a sense agnostic, because you are not, if you use full historical value, you are actually saying I'm going to meet the same level that I had last cycle. That is not agnostic anymore. You're linearly predicting. And even if you use like a decay model like this one, I'm not against of it. It's much better than using the full historical value, but it's still, you're expecting this model stay, in charge of the market's behavior. I don't like this kind of mentality. I like to use the recent data and try to predict the short-term behavior of a specific metric instead of looking at the historical value and give too much weight. You can actually use this model, but it's going to work until it doesn't. So I really don't like to predict too much into the future. But like you said, a dynamic model that use the recent data, try to do some sort of normalization in a smarter way. That's what we can do, actually. There's no other way. I mean,
And
that's
it's
what we can do.
important to remain flexible and dynamic because the nature of the market is changing so fast. Like every cycle,
Definitely.
completely different people, completely different institutions, different reasons, different fundamentals, right? So we have to always be vigilant about the past not necessarily being a great guide for future.
Yeah. One chart before we, close this episode is, it could be too bullish, or at the same time it could be too scary. I leave it to the audiences. Um, leave it to them to make a decision. Is it too bullish, or is it actually a scary chart? This is showing the size of the loss in the market as a percentage of the market cap. For example, in bear market in January 2019, this is showing 51%. That means equal to 50% of the market cap, there was an unrealized loss in the market. The unrealized loss in the market was equal to half of the market cap in that specific point. And during the bull market, obviously, this number is going to be really low because majority of people are in profit. And even if you see a little bit in loss, unrealized in the market, is the people who bought at this top, for example, and then market corrected a little bit, and we had some loss in the market, unrealized loss. What is scaring me for a long time? These, do you see these peaks in 2016? These are around like 8-9%, around 7-8%. In the China ban, we had almost to 11%, equal to 11% of market cap unrealized loss in the market. What is scaring me? We're not seeing much loss or not much pain in the market all the way. Starting when? Starting December 2023 or even earlier. December 2023, all the way from December 2023, market remained in a very profitable state. That is scary. Like, it's been a very good, a long spring in the market. That's what scares me. But the counter argument is, we are actually living a market similar to 2016. That's another argument that I've heard that they talk about. Okay, we're living in a pretty constructive spot-driven cycle like 2016. We might have some correction for sure. We might have some consolidation similar to what we had from March to September, but we're not going to have a crazy bear market for a long term. And starting December 2022, that's been the case. We didn't have a crazy correction like the one that we had China and during the China ban, or the Luna and FTX. And in this sense, it's expected because we have not experienced a very huge macro negative event yet. It remains to be seen. If, for example, we had one of these custodial being forced to sell off, what's going to happen? I'm really, really keen to see what's happening. So far, we have been living a 2016 to 2018 kind of market, but that scares me. Too much profitability for so long. That is what is always scares me, and probably I'm wrong. It's up to the audiences to make a decision. Many might say, okay, you're too skeptical, but personally, if I want to be a speculator, I think this has been going for so long, and we need some sort of correction, like what we saw in, I don't know, 2021. It could be like driven by an exogenous factor, or something happened out of the market, or simply it could be a lot of people keep taking some profit off the table, and market doesn't have enough demand, and we enter a bear market.
Let me tell you something.
Yeah.
Let me tell you something. This chart is kind of doomed to showing less spikes over time, because as Bitcoin grows, market cap becomes larger and larger, but the volatility also goes down. So the importance, or the number of people that at any point in time would go into a loss also is going to be smaller. So it's kind of like from a little cup that could have large perturbation, you are transitioning to becoming an ocean where really its level really doesn't change much. So, and a little bit of up and down really doesn't have much of an effect. If somebody's losing, some other person is buying, right? So it's all getting canceled out. So I guess this might also be an artifact of lower volatility and diminishing volatility in Bitcoin. Bigger market cap, less volatility would dampen a lot of these loss percentages.
Could be. I mean, and that's the case so far. Look at what we saw in 2015. There is a decay in the amount of loss during the market capitulation, and you're very, very right in terms of volatility. Less volatility, less unrealized, relative unrealized loss in the market, and market cap is getting, the denominator is getting bigger. So expecting this metric to actually have a strong decay is very, very. It's not the wrong hypothesis. I'm with you, but let's see what happens, huh?
Yeah, yeah,
Yeah,
let's see. So what is your overall feeling about from the data?
I think. I mean, if you were asking last week, I was expecting to. I mean, testing below 88. Just to be honest, I thought, okay, market is showing some weakness. There's this weakness in the ETF buy side, but it all changed after this news around. I mean, Bitcoin treasury. My speculation is if there isn't a slightly positive or confirmation of this news. Let's say Trump really put in a statement, I mean, day one executive order, start to create a team to design this treasury. Like something like that, I expect we had another leg up and around 112 to 125. Like I said, is the high band of the model that we just explained. That's where I'm gonna be skeptical again and say, okay, I mean, market's gonna go down. But if by any chance, like they say, okay, yeah, we were talking about the treasury, but if there is a but, I expect a weakness in the market because we had a lot of profit taken off the market when we had the first rally to 108, and market already seeing a cool down. And like we showed in last 3 episodes before we break to 88. Remember last episode we were around 94, 95. We were talking about the cooling down in the market, both in perpetual and hot, I mean the spot market. I was expecting that cool down reflects itself by a sideway or consolidation phase. So by any chance, I mean by any mean, if they start to bring a but into equation, I expect market go back to the cool down and a sideway or probably a correction.
Yeah, so
And we have to see.
we have priced in perfection, right? So
Yes.
a lot of good things need to happen to
Yeah.
support the prices.
That's my takeaway. Like I was expecting everything to enter this consolidation, but I mean, Trump is Trump. He's changing the scene really fast. Let's see what he does.
Yes, as you were explaining, I also quickly looked at funding rate. We did actually have a spike, but not massive. So it doesn't also seem like we have significant risk there. But also interesting, I think last couple of episodes we have talked about funding rate, and we mentioned that funding rate going negative is a really positive sign in terms of it's not going to last in there for a long time. So we should expect a bounce. And it looks like the recent bottom exactly happened in January 9 when we did have a negative funding rate at 91K.
Yeah.
So interesting pattern, but I don't see a significant jump today. So even though futures were very impactful today, I don't think they caused this rally or most of it. So
Yeah, people for funding, the people have to look at individual exchanges. Like today, market rally, you could see at Bitfinex, we had the highest funding rate, and the next one was Deribit. So when the moving average of funding rate on Binance and Bybit goes above 0.1, that's when I'm gonna say, hey, the degens are entering the market, and we should expect at least a midterm rally. I mean, in the market. But still, if you go look at Binance and Bybit and a little bit OKX, I'm not saying they're not positive. They reacted definitely to the recent rally, but you want to see something like this. Like what? Let me zoom out. You want to see something like crazy, like here. Look at the funding rates. It's going nuts. and in the second rally, like you could see, it's just going up. And so we have to be careful. I mean, funding rates, exchange to exchange, is really different. When we see a macro change or shift in the market, then we can actually speculate on the midterm. Look what happened in the December. Look what happened in March. All funding rates, almost all of them, broke above their neutral value. But right now, we saw a negative, like January 9. Yes, all of them were negative. That was a sign of lack of demand or speculation, probably, in the futures market. If the spot market was kept going down, that would act as an extra downward pressure. But the spot market bounced back from 89, like we explained, and futures market is following. Like I said in the last episode, in the earlier stages, spot market start to rally, then futures get warmed up. In the second half or the last stage of bull market, it is the spot market cools down, but futures market start to beat up, and you could see the funding rate going crazy and crazy. So we have to see if this spot market rally keep going, and then the futures market moving average 7-day breaks above the neutral value. That is a strong confirmation of, okay, retail are back, they are believing in the rally, and you could expect some sort of midterm to long-term continuation of the current positive momentum in the market. That's the playbook that I use. I do not saying it's going to work all the time, but using the recent examples, that's pretty solid framework.
Very good.
Yeah.
Awesome. Well, fantastic. We had a lot of great gems from you today. I think it was very. I didn't even notice how time passed. So. A great series of discussions and analyses. Thanks a lot for that. So I'm excited for where we are, and let's see what happens on Monday, because
yes,
the world will change.
Yes,
over a course of 24 hours. So let's see how many things does he sign on the first day, and what comes out of the strategic Bitcoin reserve speculation.
Yeah, let's see what Orange Man does. Let's see.
Yes, Orange Man, Orange Coin. All right, so thanks a lot for being with us, everyone, and we will see you next week.
Yeah, have a good weekend, everyone. Have a good weekend, Sina.